And here we have it. The Federal Reserve has said that all banks have passed the examination for this year's stress test. That's sort of the key headline that we were waiting to hear, and sort of we knew maybe that would be to be expected. Fed stress test finds that some of the big banks can weather some of the most severe recession requirements that they've put in place. So again, we are hearing that looking at like the Fed saying that all banks that it had examined have indeed passed this year's stress test. That's sort of the key headline. And Shanali and Romaine, of course, want to bring you in as we think about how far we've come from 2008, the way that we installed this to make sure that we weren't coming in with some of this systemic risk that we saw where maybe the financial system can take down other areas of the economy. And so we had these parameters really come through, and indeed it looks like the banks can weather the worst of the stress tests that were put into place this year.
And that's a 10% peak unemployment rate, a GDP decline of 3.5%, a 55% drop in equity prices. Remember, interestingly, the Fed is saying that the decline in capital is a little larger than what we saw last year, but the scenario was also very tough.
Yeah, and we should point out, too, I mean, obviously this is important. We should point out, though, I think all the parameters for this were kind of set before some of the latest market ructions that we've had since February. So it'll be interesting to see whether any that, if at all, would actually change the equation. Let's bring in our Bloomberg economic correspondent, Mike McKee, to talk a little bit more about this. And Mike, let's start off with those parameters, right? I mean, they kind of set the parameters back in February or something like that. So some of what happened in March, April, May wouldn't necessarily be reflected in this. But overall, it seems like the banks are in good shape.
Well, in a sense, it is reflected because the Fed uses as a starting point the fourth quarter of 2021. So what was your capital ratio then? And they measure various capital ratios, but the key one is common equity tier 1 capital. And that's the one that shows everybody passed everything. This is Lake Wobegon. All the children are exceptional. But the 33 largest banks can absorb up to $600 billion in losses. The minimum ratio for CET1 is 4.5%. The aggregate ratio coming into this was 12.4%. It only falls as far as 9.7% and rises to 10.3% during this whole period. And so all the banks are well above minimum levels, according to the Fed. In fact, the minimum level that it gets to is double what the minimum legal requirement is. So
you and I were talking about this very nerdily in the background. You know, there's a CET1 ratio, but then there's a supplementary leverage ratio, which the bankers get asked about a lot. And to what extent could that really constrain them from giving back more money to investors, to the economy? How much is this all in limbo when we don't know what regulation looks like at the Fed yet?
Well, the banks are going to go ahead with whatever plans they have, and it looks like everybody's going to be able to do pretty much what they want. Banks are allowed to announce what their capital plans, distribution plans are for buybacks or for dividends on Monday, the 27th at 4:30 p.m. So we'll be back here looking at what the banks want to do. And at that point, the Fed could step in and say you're not well capitalized enough. But given that nobody even comes close to the minimum here, it's likely that all of them, unless somebody is really trying to give away the store, all of them will be permitted to do what they're looking for.
They talk in about the third paragraph down. The scenario is tougher than last year's test. They do that by design. And they look at really the commercial real estate and some of the corporate debt markets. And a lot of the losses coming from trading counterparty losses, loan losses. This is certainly something we've been talking about as you're seeing, and I want to be mild here and watch my words, a little bit of widening in credit spreads, but nowhere near sort of the huge blowouts that we've seen in previous crises. How are you thinking about sort of the loan losses and some of the counterparties that this scenario has sort of represented?
Well, interestingly enough, the biggest losses that the banks would incur come on credit cards. If we have a scenario where 10% of the population is out of work, you're going to have a lot of people who are defaulting. And then there are real estate losses, which are pretty big. But in all, it's sort of spread out based on the percentage of how much each bank does in each business. So different banks will have different results and different projected losses for different categories of credit.